Thrilled to have Jason Hartman as our guest today. How you doing, Jason?
Good, David. It's good to see you.
Likewise. Well, I met Jason a few months ago at Snowbird and a fund IFS fund event, and we were able to connect. And I'm really looking forward to diving into what's going on in the world today, real estate, a lot of different predictions, a lot of different things going on. So let's dive in, Jason.
Sure, absolutely. So we are at a really crazy time. There's a lot of bad news out there. There are a lot of concerns, a lot of wild cards. Regardless of what I say today, I just want to tell everybody that there will be at some point a correction in the market. There's so much money out there floating around, and it is just looking for a place to go. They're looking for assets. They're looking for investments. The world is awash in money. I mean, it's just the amount of money that has been created both during the Great Recession 12, 13 years ago, and then during the COVID pandemic is just absolutely historical in nature.
Yeah.
So it is looking for assets in which to buy. There's quite literally an asset shortage. And one of those assets that's the most desirable, I think it's the most historically proven asset class in the entire world, is income property. And so I'll talk about that a little bit. I'll share my slides. For those of you who might be listening on audio only, we'll try and just explain the visuals we're seeing. So if you don't have access to the visuals, we'll tell you what they're about.
Perfect. Okay? Now you've been investing in real estate for 18 years, correct?
Oh, I've been investing for longer than that.
Longer than that,
I bought my
okay.
first rental property when I was 20 years old. But I've been working exclusively helping investors buy properties nationwide for about 18 years now or so.
Great.
Yeah.
Okay.
And I am CEO of Empowered Investor, and that is the name of my forthcoming book, Empowered Investor. And I just like to maybe start by talking a little bit about, predictions.
Yes.
And predictions are a risky business. Okay. So just understand that there are a lot of wild cards, not the least of which is the invasion of Ukraine. I mean, this could just go a lot of different directions. We are essentially in a proxy war with a superpower, with nuclear weapons. So this is a really different kind of thing than Iraq or Afghanistan or any of these. This is very different this time.
Very risky, correct,
that
yes.
Is definitely a wild card. But, just take for a moment, let's take a look back at where we were over the last year or so and where we're going, where we are now. So last year, the typical homeowner gained about $57,000 in equity, and that was up about 31% in terms of equity, not sales price, but equity in their home. And that's about $3.2 trillion. So just to give some comparison there, because you got to always ask compared to what? The GDP of the entire country is just over $20 trillion a year, okay? And the tax revenue the government gets every year is about $4 trillion a year. And the country's budget is about $7 trillion a year. So you can see we're spending too much money, more than we take in, which is not a good business plan. But homeowner equity increased by about 3.2 trillion last year. So that's pretty darn significant.
Now, would you say that appreciation was part of, obviously, the printing of the money, is a low supply, inventory issues? What are the causes for that such a great increase on equity?
Yeah, good question. So certainly the money creation has just put so much money into the system, chasing a limited supply of goods and services. And so you see run-ups, you see all the inventory get swallowed up. And this chart just shows an example of what we're looking at in terms of inventory. It's absolutely amazing, okay? And actually, this is how we started the year, okay? With inventory of about 293,000 homes. And this is where we are now at about 241,000 homes.
Okay.
So inventory has actually declined since the beginning of the year. Even when most people are predicting that the market's finally going to slow down, it's doing the opposite. It's absolutely crazy right now. The market is just red hot. To compare this to something, the experts will tell you that we need about 1.2 million to 1.5 million homes on the market to be in a balanced, normal market.
Okay.
So we only have about 200, less than 250,000.
Big difference.
Homes. Yeah. So it would be like this. It would be like you walking in a grocery store and seeing about 60 to 80% of the shelves vacant, empty, nothing on them. And only 20% to 30% where it has products on the shelves. That's how low the inventory is. It's absolutely incredible right now.
This is happening in almost every single market. So yeah. it's we can say it's a nationwide issue.
Yeah, it is a nationwide issue. Of course, markets vary. All real estate is local. They do differ, but overall inventory is just tight just about everywhere. It's very, very tight. And one of the things that nobody's really talking much about is how I believe that with these historically low interest rates, David, we're going to see millions and millions of homeowners in the future, investors and homeowners, not willing to sell their homes in the future because they can't replace these incredibly low rate mortgages that they already have. The whole country has purchased a home or refinanced a home in the past 2 years. And interest rates are higher now, and they're likely to go quite a bit higher in the future. So, that mortgage becomes a huge asset, and it's an asset people don't want to give up.
Yep.
So instead of selling their house, whether it be a rental property or a personal residence, they're going to improve their house if they have money to do it. They're going to remodel, they're going to add on, they're going to improve the house because then they don't have to give up the mortgage. They can keep the cheap mortgage, okay?
And also for them, it's harder to buy another property because inventory is so low and prices are so high that they might not be able to do it.
We don't know that that'll be true in 5 years.
Yeah, okay.
So inventory might be higher and prices might be a little more reasonable. They might be softer, but millions of people will still not want to let those cheap mortgages go.
Correct. Yeah.
Because if inventory is higher and if prices are more reasonable in the future, it would be a result of higher mortgages most of the time, higher mortgage rates.
Yep.
So this is going to cause people to hoard their homes, and I think it's going to keep housing supply short well into the future. We'll see. But nobody's talking about this. That's why I wanted to mention it.
Very interesting.
So I teach a strategy called inflation-induced debt destruction that basically talks about how inflation pays your mortgage for you. And one of the things when we look at prices is we've got to compare it to something. And you saw me talk about this before when we were in Utah, okay? And so we've got to measure it against something else to know the value. Now, the big mistake is that most people are measuring the price of real estate against only one thing, the dollar. And the dollar is a moving target. I mean, the dollar today is worth quite a bit less than it was 10 years ago.
2 years ago.
Yeah, you're right. 2 years ago, for sure. But definitely 10 years ago, even more, right? And 30 years ago, even more than that. So the dollar is a moving target. Why would someone think, okay, the median house price is over $350,000 now, but that's only dollars. What's the median house price in gold or oil or rice or Bitcoin, right? There's a whole bunch of things to compare it to.
It gives you a different perspective. Just gives you a different perspective. That's for sure.
It gives you a much more accurate perspective when you compare it to a basket of goods.
Yep.
Okay. So, I'd like to really focus on this compared to what discussion today, if we can.
Sure.
But before we do that, you know how we talked earlier and you were saying inventory is tight in pretty much every market, right?
Yep.
Well, let's divide up the types of markets before we look at the Hartman Comparison Index.
Okay.
And let's divide them into 3 types of markets. Linear markets. These are these slow and steady and profitable markets with really good cash flow for investors.
Correct.
And then cyclical markets. These are the markets with the ups and downs, like a roller coaster. And then hybrid markets, which are in between the two. These are the 3 basic types of markets. So this is Memphis, an area where we've helped hundreds of investors buy properties over the years. And you can see, looking at a price chart here, that it's pretty linear. Right? It just kind of goes up and it has little downs and little ups and, downs and ups again. But overall, it's pretty smooth. Okay. Indianapolis, another market where we've helped hundreds and hundreds of investors buy.
Great market, yep.
Same kind of thing, very linear market. But guess what? My hometown where I grew up, this is Los Angeles. I mean, that is up and down. The chart looks like a roller coaster, doesn't it?
Yep. Markets like LA, Las Vegas, Phoenix, Miami, I would say.
You got it. You got it exactly. Those are cyclical markets. And those markets always have a couple things in common. They have very high land values. They are very volatile and cyclical, and they have very bad cash flow. So they're not very good places to invest. Yep. They're good places to speculate. And if you get it right, you could do really well speculating. But if you get it wrong, it could be bankruptcy and foreclosure.
Yep.
Okay. Yeah. So answering that compared to what question with the index is interesting, because if you look at gold compared to the price of housing, in 1970, we were still on the gold standard. In 1971, we went off. So I'm not going to really use 1970, but it's good to know gold was $35 an ounce. The house was $23,000 and 654 ounces of gold to buy a house back then. Okay. But let's look at like 1980 or 1990. Let's take 1990, for example, 32 years ago. The median house price was $95,000 approximately. Gold was $4.15 an ounce. It took 228 ounces of gold to buy the median price house back then, 32 years ago. Today, at the end of last year, I should say, to be more correct, the median house price was $358,000. Gold was $1,805 an ounce. So you would need 196 ounces of gold to buy the median price house.
Yep. Less than what I needed in the 80s.
Yeah, it's all over the board. It's just another of many measuring sticks. Sometimes it's higher, sometimes it's lower. But if you look at the last 32 years, right, and you look decade by decade, in 1990, 228 ounces of gold to buy the median price house. In 2000, 520 ounces of gold. So it got way more expensive in the year 2000. 2010, it got cheaper because we were Great Recession, right? Yep. Prices were low then, 158 ounces, cheaper than it is today. 2020, 164 ounces, but just a couple months ago, 196 ounces. So overall, historically, when you ask yourself the question, priced in gold, is real estate cheap or expensive? Most people would say it's pretty cheap.
Yep.
Okay? And you could do the same thing with oil. Oil is one of the most important commodities in the world. It basically runs the world. In 1970, the median house price was about $23,000. Oil was only $4 a barrel. Okay? And now we know it's gone way up since my chart. My chart has to be updated because oil with the Ukraine crisis has gone way up.
Yep.
But, it cost 6,400 barrels of oil to buy a house in 1970. In 1980, house price tripled in dollars. Oil price went up almost tenfold, per barrel to $37. So it took just over 1,700 barrels of oil to buy a house in 1980. In 1990, it was 3,500 barrels of oil, so it doubled priced in oil in 10 years. In 2000, about 5,300 barrels of oil to buy the median price house. Today, about 4,500 barrels of oil. Actually, today...
Probably less.
But at the end of last year, it was about 4,500 barrels of oil to buy a median price house. But isn't it interesting, David, to look at that in other things other than dollars?
Yep.
Yeah. What do you think?
Very interesting. No, I think is, it just gives you such a huge perspective on where you're determining if really the price of real estate, is high or low compared to a commodity like oil in this case. Right. Now, what happens now? Obviously, here, we're not including the political part of it, right? What is affecting the price of oil to go down or to, so that's the only component that obviously the chart doesn't show.
Right. But, look, say that the Ukraine-Russia crisis resolves in a few months. Hopefully it will. Hopefully it'll resolve really quickly.
Hopefully.
You know, hopefully they'll get some negotiations going and they'll settle something. I don't know. Maybe Ukraine will give up a little territory to Russia. Who knows, right? But, you know, if you just think, okay, maybe oil will settle back in around $80 a barrel. Yep. Then that's the price. Okay. So if you look at it compared to rice, I mean, rice is the food supply, the basic food supply for about 2/3 of the world.
Yep.
It's a very important food. You know, in 1970, a house was much more expensive priced in rice than it is today. Same with 1980. And then, you know, in 2000, it was a little more expensive. Right now, you know, it's kind of historically cheap compared to all these times. Yep. Not the cheapest it's ever been, but still fairly cheap.
But it's not the most expensive either.
Yeah.
It just gives you, I mean, I like this comparison. Like I said, once again, it just gives you perspective on how we determine really the price, in this case of real estate, if we're looking at median home price, is compared to commodities. And
yeah, you're absolutely right. Yeah. You know, we could also compare it with the S&P 500 index. Okay. And with the S&P 500 index of stocks in 1970, it took 249 shares of the S&P to buy a house. Today, it's only about 75 shares. Yeah. So priced in the S&P, houses are cheaper than they've ever been.
Yeah. Now, also, it's crazy. Yeah. Also, obviously, the stock market is inflated completely, especially Standard & Poor's index, right? With all the trillions that was poured into the economy as well. So, what would you say if, let's say, there's a correction on the stock market? Probably that will go to, I don't know, half of that. But it's still.
Well, then if it goes down by half and the house price doesn't change, it will take 150 shares of the S&P to buy the house.
Correct.
And so it won't be cheaper than it was in 2020 or even 2010 or 2000, but it'll be cheaper than it was
in the 90s. Yeah.
The other decades, the 90s, the 80s, and the 70s. Yeah. So it gives you a really good comparison. Here's one that's good, is how many years do you have to work if you earn the median income to buy a house with cash? Not a mortgage, cash.
Okay.
In 1970, you had to work 2.6 years to buy a house with cash. Save all your money, don't spend anything. 2.6 years of your income would buy you a house with cash. In 1980, 3.8 years, so it got more expensive based on income. 1990, 4.1. 2000, also 4.1, didn't change. 2010, 4.6 years. Today, 5.3 years.
Yeah. So we see a trend.
Yeah. Priced in income, in median income, housing has gotten a lot more expensive.
Yeah. Yeah. And that would probably contribute to the gap between the rich and the poor, right?
Yeah. Yeah. And it's terrible. The wealth inequality is becoming a real problem in this country for sure. Yeah. But thankfully, David, almost nobody's buying a house with cash. They're getting a mortgage. So if you want to move on to the mortgage side, because this is all just assuming you're paying cash for the house, okay? What if you get a mortgage, okay? Let's just move on. It's not about the price. It's about the payment on the house. So here's a real life story. When I was 24 years old, I had this girlfriend, and I sold her this condo. I was a realtor, okay? And I lived right near here, and she moved into my neighborhood, okay? And she bought this condo in Irvine, California for $168,000. And I was thinking about this the other day because she was 26 years old when she bought that condo. And I was thinking, has life gotten better or worse? Like millennials, you're always hearing them complain about how much worse life is, right, than it was for their Gen X or baby boomer parents, right?
Yep.
And they've got some reasons to gripe. I mean, I agree in some cases, but not all cases. In some ways, life is much better for them. In some ways, it's worse, okay? But a 26-year-old bought this condo in a nice area of Irvine, California for $168,000. Okay, fine. Now, the 30-year fixed rate mortgage has been declining and declining and declining since then. So mortgage money is really, really cheap.
Yep.
Back then, the payment on that house would have been about $1,600 a month. Principal, interest, taxes, and insurance, PITI. Today, that house is worth $665,000. It's gone way up.
Yep.
Okay. The payment on the house today is about $3,400. So anyone would look at that and think, oh my God, housing is way too expensive. It's not fair. The younger generation can't become homeowners. They can't afford it. But wait a sec. Let's adjust for inflation. And when we adjust for inflation, we're only going to use the official rate of inflation.
Which is not accurate.
As you know, yes, very good. It's understated, right? You probably tell your listeners that all the time.
Yes.
Okay, I bet you do. Because it's fake news. The inflation rate is much higher than they tell us, which would actually make this payment even cheaper. But we're not going to use the real rate of inflation. We're just going to use the lower understated official rate by the CPI. So if you adjust $3,400 a month for the consumer price index for all that time, this is what happens. This is going to amaze you. Okay, compared to what? Let's compare it to inflation. So here's what happens. Back then, payment was just over $1,600. Inflation adjusted of today's payment, okay, equals $3,388. The real difference is only $69 a month. It seems much more expensive, but it's really not.
Because you got to compare the dollars back then to the dollar right now.
And the
inflation
interest rate.
added, and the interest rate.
The interest rate is much lower. So the house price is way higher. It's more than triple what it was. But inflation kicked in to reduce the value of that monthly payment because it reduced the value of the dollars. And the interest rate got so much lower. Okay. So
now the affordability though for like a regular homeowner, he hasn't seen that increase in income, right? And if you add the inflation in there, maybe obviously they're not making as much as they probably would have back
that's
then.
A good point. You raise a good point, and we're going to look at that. Okay,
cool.
So give me just a minute. Okay, let's just do the inflation adjustment here for a second, then we'll look at the income. Okay, so let's go back 52 years to 1970. The mortgage payment on the median price house 52 years ago, okay, was $127 a month. Adjusting that for official rate of inflation, which is understated, it's $164 today. So it's more, but the inflation's understated. So here is a more real estimate of inflation. You might have heard or talked about on your show shadowstats.com.
Okay, yep.
I had the founder on my podcast. His name is John Williams. And what he does is he calculates what he thinks is the real rate of inflation, okay, before they started manipulating the consumer price index, the CPI, so much. And according to Shadow Stats, this $164 payment today compared to the $127 payment 52 years ago, it's really $53 today.
Yeah.
So the real house payment is less than half of what it was in 1970. So I ask you this, is housing cheap or expensive? It's actually quite cheap. People just look at absolute numbers and they think, oh yeah, sonny boy, when I was your age, my mortgage payment was $127.
Yeah, when you obviously you include inflation and you do this analysis, you realize
and now your payment is $3,300, or $1,214 to be specific. Okay, yeah, $3,300 was that prior example. Okay, but look at this. So here's the mortgage payment in barrels of oil and ounces of gold. The monthly payment, not the house. This is much more accurate right here. In 1970. You'd have to have 3.6 ounces of gold to pay 1 month mortgage payment. Today, you only have to have 0.7 ounces of gold to pay 1 month payment. In 1970, you had to have 36 barrels of oil to pay 1 month mortgage payment. Today, you only need 15. Not the cheapest it's ever been, because in 2010, only needed 8 barrels of oil to pay your mortgage. So that's a comparison. Okay, here we go. Shares of the S&P to pay your monthly payment. Not buy the house, not with cash, monthly payment. 1970, 1.4 shares of the S&P. In 1980, it got real expensive, 4.7 shares. 1992 shares of the S&P to pay your monthly mortgage. But today it's only 0.3 shares. And look at this. Mortgage payment in hours worked at the average wage. This is the best metric of all. It's exactly what you were talking about, David.
Yep.
How many hours a month does someone have to work if they're making the average wage to pay their mortgage? 1970, 41 hours. 1980, 45 hours. 1990, 39 hours. 2000, 41 hours. 2010, 34 hours. End of this, a couple months ago, end of the year, 47 hours.
And I bet that number might be decreasing based on companies offering higher wages. I know you're basing on the minimum wage. I get it.
No, not minimum, average.
I mean, average.
Yeah.
Because of staffing issues. And obviously, actually last week I had the founder and of a sandwich chain, the owner, the CEO of Capriotis. I don't know if you ever heard of that sub chain, but he was telling me the staffing issues is just tremendous. So they're offering like a lot more above median, wage.
Yeah. The Great Resignation has caused a real shortage of workers and the low birth rates. I mean, people in the U.S. have got to start having some kids, because we're going to go extinct. And around the world is even worse. Japan, Russia, Western Europe, they're just not going to exist soon because nobody's having kids, okay? The replacement rate is every woman has to have 2.1 children. And
it's not happening.
In Russia, Japan, Western Europe, I mean, the birth rates have just plummeted. So there's not enough people. So that means wages are likely to go up even more.
So we also have an inventory issue with people.
No question. Yeah, so if you look at this in hours worked at the average wage, it's a little more expensive, but not much. I mean, not much. By the way, one thing I should tell you is the house is much bigger than it was in 1972. That median price house in 1970 was maybe 1,000 to 1,200 square feet. Today, it's about 2,200 square feet.
Yeah.
So it's better in that respect, but it's also worse in the fact that in the old days, your house came with a big yard.
Yeah.
Now it's crammed in, really dense. So you give and take. Yeah. But anyway, that's the scoop. That's what I've got on the comparison.
That's great. I mean, like I said, and I said it again. I mean, it just gives you such a huge perspective, right? Because everybody's talking about, it's crazy how prices are so high, it's impossible to buy a house. But when you look at this and you analyze and you compare it to that, and that's what I loved about your presentation back in Utah, it just gives you a whole different perspective. Yeah. Now, what do you think? Obviously, we a lot of things are being said about correction, I heard your podcast last week with Harry Dent, and he predicts a tremendous collapse, recession.
But he's been predicting that for 20 years, just so you know.
Yes, that's correct. But what do you think? I mean, I know it's very hard to predict when and how exactly it's going to happen. But based on your charts, based on the comparisons that you're doing, based on the supply issues, what are your thoughts? I mean, for a real estate investor like I am, or when I talk to investors, they ask me, David, what should I do? Should I invest right now? I'm always telling them, yes, as long as the property is cash flowing, number one, and you're buying at a discounted price, do not buy for appreciation.
Can you buy properties at a discount anymore? Every deal looks good in the rearview mirror. It never looks good when you're getting it, really.
Yeah. I mean,
as whatever it's worth. Look, here's my answer to your question, okay? There are wild cards. There are black swan events that really can throw any prediction way off. We've got a very unstable situation in Europe right now. I don't know. Nobody knows what that's going to lead to. Nobody knows. Okay. But I can tell you that all you have to do to know if we are getting into a downturn is just look at the inventory levels. That's so easy to do. Right now, inventory levels are lower than they've ever been. Okay. If inventory starts increasing by 300 to 500% to get to what they call a normal market of 1.2 to 1.5 million homes for sale, then you start to think, wow, okay, the market has really leveled off. We're in a market of equilibrium, not a seller's market anymore, where inventory has gone way up. Why did that happen? Something must be wrong. That's a sign of a concern.
Yeah.
Now, just so you know, if inventory increases 3 to 5 times or 3 to 500% of what it is now, that will only be considered a normal market by most experts. That will not be considered a down market or a buyer's market yet. It would have to go up even higher than that. Okay?
Yep.
So watch the inventory. It's not that complicated. Okay? That's the canary in the coal mine, so to speak, right? They would bring the canary in. If the canary died, it was unsafe for humans to be in there, right? Because it couldn't breathe. That will tell you if inventory goes way up like that, it's time to be worried.
Correct. Now, what about the interest rates? I mean, obviously, we're going to see them going up.
Interest rates would cause inventory to go up.
Because less people
So if the interest rates get really high and housing becomes really unaffordable, then inventory will increase.
Yep. And there will be less demand.
Yeah.
So less supply issues.
So you can simply look at the inventory and it'll answer your question. Inventory is a really important thing to look at.
Okay. What is your prediction on the financial assets? Stocks?
Oh gosh, there's so many of them. And, I really focus more on the real estate. But do I think the stock market's overinflated? Of course I do. Do I think there are some cryptocurrencies that are overinflated? Of course I do. Do I think art market is overinflated? Absolutely. Do I think NFTs are ridiculous? Yes.
Now, what do you think if that actually happens? There's a bubble burst in the financial market.
How is that going to
how is that going to spill into real estate for real estate investors like us if we see that happening?
It's complicated, but look, there are so many interactions. This is why economics is just a very difficult thing, right? Nobody knows that you're basically trying to predict the decisions of billions of people in the world, what decisions they'll make, right? Which will influence the price of things and the supply-demand ratio. But look, keep it simple. Don't agonize over all that stuff too much. Look at the Hartman Comparison Index. Go to my website, jasonhartman.com, sign up and get on our mailing list because we email out updates on the Hartman Comparison Index. And watch the inventory. If the inventory skyrockets, that's a concern.
Yeah.
But until then, it looks like, barring the wild card with war, it looks like we got another year or two of a very strong seller's market with prices increasing.
Now, what about the linear markets, right? Are those the markets that you prefer to invest, obviously, because cash flow is good?
Linear markets are the best, yes.
Yep.
Linear markets are much more prudent, much less risky, because they have good cash flow, good fundamentals, and they don't have big swings in price and big volatility.
Correct. Okay.
So I would always gravitate toward linear markets. And, you can find out more. This stuff is deep, right? In addition to listening to your show, check out my YouTube channel. There's lots of info there. Check out my podcast, The Creating Wealth Show, and just get on the mailing list because we send 2 emails per week, and they're very informative emails that will keep people up to date on the Hartman Comparison Index and the inventory levels and, our predictions on all of this stuff.
Great. Okay? Now, in one more concept that I would like just to touch base, and you can probably expand on the concept, is the inflation-induced debt destruction. Why, and you can just explain a little bit more to our listeners, why buying a real estate property with debt right now is probably the best time ever to do it.
Well, to explain that properly, we need to do another show, okay? Because it takes about a half hour for me to really go through that with the visual aids and show people exactly how that works.
Okay.
But just conceptually, I trademarked the term inflation-induced debt destruction years ago. It's kind of a mouthful, IIDD, inflation-induced debt destruction. But what it demonstrates is that as you have a 30-year fixed-rate mortgage, right now it's below the rate of inflation. Inflation comes along and essentially pays that mortgage off for you because you're paying the mortgage back in cheaper dollars that have depreciated in value. So if the payment starts out at $1,000 a month and you have 10% inflation, it's only $900 a month the following year.
Yep.
If you have another 10% inflation, 10% of $900 is $90. Then the following year, it's only $810 per month.
Yep.
Not to mention, it also works on the principal balance. So if you have $1 million in mortgages on maybe a few different single-family homes that you bought through us at jasonhartman.com, shameless self-promotion. If you have $1 million in mortgages and you have 10% inflation, whether it takes 1 year, half a year, or 2 years, or 3 years, doesn't matter, 10% happens, you've effectively got $100,000 of that loan balance paid off by inflation. It's a beautiful thing.
It's a beautiful thing. Yeah,
this is amazing. The hidden wealth creator, David.
Yep.